On June 11th, a netizen posted a video on social media claiming that his mother brought her bank card, ID card, and other documents to the Jilin Bank in Chongchuan City to withdraw money, only to be told that she needed to report to the police first. The incident quickly went viral online. The netizen said that his mother wanted to take out the money and deposit it in another bank with a higher interest rate for a total amount of less than 100,000 yuan. But the counter clerk said the police station should be notified if the amount is more than 20,000 yuan. So they waited a long time, and only after the police station had completed the review did they successfully transfer the money at the bank window. Some netizens question whether it's still a good policy if banks have enacted a lot of measures to regulate the financial market, or if the implementation of these measures has caused inconvenience to the people by adding more and more layers of restrictions. Some netizens criticized it as people having the freedom to decide what to do with their own money. Why do they need approval from the bank? Many netizens lamented that the banks in China are really in trouble. Customers can't even take out money freely anymore. Staff from the related branch of the bank in Jilin explained that this practice is to prevent email fraud. But the related police station staff responded this way. There is no such thing. Normal withdrawals are fine. If you want to withdraw a large amount of money, you should report to the bank in advance, and we will review some irregularities in the source of the money. Since banks and police have different stories to tell, it's not yet clear where this restriction actually comes from. A lawyer from Guangdong Shenfan law firm released a video saying this. This is to restrict the freedom of depositors to withdraw money under the guise of helping them. Article 29 of the Commercial Bank Law stipulates that commercial banks should follow the principle of voluntary deposits, freedom of withdrawal, interest on deposits, and confidentiality of depositors when dealing with personal savings deposits. Freedom of deposit and withdrawal is a basic right of the depositors, and neither the police station nor the bank has the right to intervene. Such news of having trouble taking out money from banks has happened around China before. A number of banks have set limits on bank transfers and withdrawals, as well as banks blocking customers' bank cards for no apparent reason. On June 14th, a reporter consulted several bank outlets in Shanghai concerning the issue of cash withdrawal. Banks such as Construction Bank, Agricultural Bank of China, Industrial and Commercial Bank of China, Bank of Communications, and Shanghai Bank said that withdrawals of 50,000 yuan and above need to have an appointment at least 1 day in advance, while withdrawals of 50,000 yuan or less can usually go directly to the branch. Recently, a girl had to jump through all kinds of hoops set up by her bank to take out money for an emergency. Having spent more than an hour in the bank, she still didn't get the money, putting her on the edge of tears. This is a netizen filming the actual situation of withdrawing money from a bank. A man from Fujian was questioned about what he planned to do with the money he took out. It enraged him. He decided to cancel his account and withdraw all the money he had deposited. However, the staff said that it was okay to cancel it, but there had to be a good reason. Then a dispute broke out between the two parties. Cancel the card for me, cancel it, and return the money to me. I'm not putting it in the bank anymore. In addition to the anger over the difficulty in withdrawing money, the public is more worried about the financial situation of the bank. A financial blogger commented that the difficulty of depositors to withdraw money de facto shows that the Bank of Jilin has been hollowed out, and the money that can really be utilized is not much at all. Some netizens followed up. This is not an individual phenomena, it's happening everywhere where withdrawing money is becoming difficult. Many banks can only take up to 50,000 yuan, and they also track the person who withdraws the money to see what one is doing with the money. This means that almost all local banks are going to be in trouble, because just like everybody else, banks are led by the CCP, and they have to serve the local economy, that is, the government's pocketbook. It's easily hollowed out. It is worth noting that data from China's State Administration of Financial Supervision shows that in the first 5 months of 2024, a total of 1,257 bank branches exited the market. This represents a year-on-year increase of 30.41%. Among them, branches of rural commercial banks accounted for the highest share of 41.93%, totaling 527 entities. Rural credit unions and their branches accounted for 21.16%, totaling 266 entities, and branches of large state-owned banks accounted for 18.06%, totaling 227 banks. In addition, 16 branches of foreign banks, 6 branches of policy banks, and 5 branches of rural cooperative banks have also exited the market. The public has lamented that a wave of bank bankruptcies is coming. According to David Huang, an American economist, the current state of China's banking sector reveals deeper problems in the economy. Beijing's previous emphasis on the internet and wafer development has led to a hollowing out of the real economy, which, combined with policies such as COVID-19 Dynamic Zero and trade wars, has led to a rapid economic downturn. The banking sector is highly indebted and unprofitable, making it difficult to maintain its huge operating costs. David Huang pointed out that the current economic measures have not solved the fundamental problems. First, taxes should be drastically reduced to ease the burden on businesses. Second, monopolies should be eliminated to increase opportunities for businesses and individuals. Until these problems are solved, it will be difficult for China to get out of the economic downturn and for the banking sector to regain its vitality. While a large number of bank branches are leaving the market, the bad debt problem of the Chinese banking sector is also getting more and more serious. According to a March 27th report in The Economist, hundreds of banks in China are experiencing a surge in bad debt, which has become a ticking time bomb that could have unpredictable consequences if detonated. Previously, in Henan province, the village banks exploded, and their depositors were violently suppressed by the CCP when they sought to defend their rights.
现场聚集人员，你们的行为已经涉嫌违法，限10分钟内离开。如不听从现场工作人员劝阻，拒不撤离，扰乱通信，影响社会正常秩序。
In addition, the CCP's promotion of digital money and online payments, while convenient for monitoring and control, also reduces the need for physical bank outlets. Overseas China expert Wang He pointed out that the banking system used to lie down and make money, but the economic downturn, bailout measures, and compression of interest margins have led to a concentration of risk in the banks. Now layoffs, pay cuts, and poor stock market performance have reflected the decline in banks' business conditions and public trust. In recent years, the Beijing authorities have been making efforts to prevent and resolve the risks of small and medium-sized banks by allocating hundreds of billions of capital to replenish small and medium-sized banks. Between January and May 2024, agricultural and commercial banks and village banks became the focus of cutbacks. There are more than 4,000 banking and financial institutions in China, and more than 90% of them are small and medium-sized banks, of which agricultural and commercial banks, village banks, and city banks are the main components. Their risk tolerance is weak, and their operating conditions are poor. David Huang pointed out that the agribusiness banks have a close relationship with local governments, and they often handle corporate bonds and loans from local governments. Due to the pressure on local finances and seriousness of debts, the profits of agricultural and commercial banks have been greatly reduced, and the non-performing asset ratio is high. The operating and profitability of agricultural and commercial banks and agricultural credit institutions are relatively low, and their business scope is narrow. During the internet finance boom, they tried to overcome the performance bottleneck by issuing deposits and loans online. But they also became the worst offenders in terms of illegal loans and deposits and had serious bad debt problems. China's banking crisis doesn't stop there. Recently, many banks have suddenly taken down their wealth management products in large quantities. According to incomplete statistics, more than 20 wealth management products have been terminated early since June. These financial products are mainly issued by subsidiaries of banks and are officially advertised as having a high safety factor. Banks originally relied on these products to attract customers. Thus, the sudden, early termination of these products has sparked widespread concern. According to Ma Jingbo, former senior editor of China's leading media outlet Southern Weekend, the main reason is that these products are likely to lose money. To avoid having to explain to customers in the future, banks chose to remove them from the shelves early. Bank wealth management products are usually invested in time deposits, certificates of deposit, bonds, and other relatively stable assets. If market interest rates continue to fall in the future, the yields of these products will not be able to support the investor's financial returns. Another analysis pointed out that the reason why banks suddenly shelved a large number of wealth management products is that the market generally expects the interest rate to be lower and lower. Recently, several small and medium-sized banks in China have lowered their deposit rates. For example, Lanzhou Agricultural and Commercial Bank lowered its 3-year fixed deposit rate from 2.7 to 2.6% on June 4th. Several small and medium-sized banks have also lowered their 3-year fixed deposit rates. After several rounds of interest rate cuts, it is now difficult to find time deposits with interest rates above 3%. Commercial banks' net interest margins have also been shrinking. At the end of 2023, commercial banks' net interest margins fell to 1.69%, the lowest in history. In the first quarter of this year, it fell further to 1.54%. To guarantee profits, commercial banks have had to continue to cut deposit rates. I never expected that it would be more difficult to save 200,000 than to borrow 200,000 because many banks have removed large denomination certificates of deposit. Recently, China Minsheng Bank has stopped selling large denomination certificates of deposit products with maturities of 6 months and above nationwide. Individual certificates of deposit of more than 200,000 yuan can be deposited for 1 or 3 months, and the annual interest rate has also dropped to 1.7%. Moreover, China Merchants Bank and Postal Bank have also removed 3-year and 5-year large denomination certificates of deposit, and even the Bank of Communications has cut off all large denomination certificates of deposit. What has actually happened? In fact, everyone's enthusiasm for deposits is so high that banks are afraid. The deposit interest that banks need to pay has greatly increased, but the scale of loans cannot keep up. The pressure on banks is too great. Last year, household deposits across the country increased by an astonishing 16.67 trillion yuan, equivalent to more than 10,000 yuan per capita in the country. This data is the most explosive in history. But this year, household deposits increased by 8.56 trillion in the first quarter, already more than half of last year. Therefore, to reduce the burden, banks have to take action on deposits. Moreover, last year, the 12 national joint stock banks made a total of 17.1 billion less, and their incomes were plummeting. The interest difference between deposits and loans fell to 1.14%, which shows that it's difficult for banks to make money and they can only give less to depositors. To pay interest, you can only cut off large denomination certificates of deposit with high interest rates. Financial data also show that broad money, M2, grew by 7% year-on-year in May, the lowest rate of growth since statistics began. Narrow money, or M1, fell by 4.2% year-on-year, the second consecutive month of negative growth, also a record. This indicates businesses and individuals aren't willing to borrow. Businesses lack desire to invest and expand, and economic vitality has weakened. To stimulate the economy, lending rates need to be lowered further. This situation is reminiscent of the bursting of the Japanese economic bubble in the 1990s, when people preferred to put their money in banks even though the interest rate on deposits was zero. This phenomena is known as the liquidity trap, meaning that people don't spend money but only save it, freezing the flow of money. As a result, even if the central bank prints more money, enterprises and households will only use it to pay off their debts instead of spending and investing. In addition, the bursting of China's real estate bubble has also had a significant impact on the banking sector, which is facing multiple challenges and adjustment measures as China's economy declines and financial risks increase. First, banks have lowered down payment ratios for home purchases to 15% in every city in the country except Shanghai and Shenzhen. Although this lowers the threshold for homebuyers, banks have to bear 85% of the loan risk, especially in major cities where housing prices can be in the tens of millions. A 15% down payment doesn't provide enough of a safety cushion, and banks are at great risk in the event of housing price fluctuations. Secondly, banks have lowered their lending rates. The profitability of banks mainly relies on the difference between the interest rate on loans and the interest rate on deposits. However, the scale of deposits of residents and enterprises is close to 300 trillion yuan, and the policy is to continuously reduce the interest rate on home purchase loans and even reduce the interest rate on stock housing loans soon. As a result, the net interest margin of banks has dropped to 1.5%, which is the lowest in more than 2 decades, and the profitability of banks has dropped drastically. The financing costs have shown a downward trend in the past 2 years, reducing the financial burden on enterprises and supporting production expansion and operation. The mortgage interest rates have continued to decline, moderately easing the pressure on residents to repay loans, thereby stabilizing investment and consumption expectations. In addition, the wave of people repaying their loans early and defaulting on mortgage repayments has also been increasing. Mortgage loans used to be the best and most stable assets of banks. However, under the current economic recession, many homebuyers have chosen to repay their loans early or simply discontinue their mortgage repayments. And this has caused the size of the bank's quality assets to shrink continuously. To cope with these challenges, major banks have adopted various measures, such as the elimination of 3- and 5-year deposit products and the suspension of the issuance of large certificates of deposit, as mentioned earlier. In some regions, they have stopped the operation of soliciting deposits. For customers who repay their loans early, banks require them to wait for several months for an appointment and charge them a penalty. Banks in Beijing and some southern cities have introduced the interest-first principal-later mortgage policy, whereby only the interest would be repaid in the first 3 years and the principal would be repaid after 3 years. To compete for quality customers, banks are offering personalized loan packages, and the mortgage market is gradually turning into a buyer's market. Instead of foreclosure, litigation, and auction, banks have adopted a more lenient policy for customers who have broken their mortgage payments. They start negotiating with customers to allow them to continue to make their payments while living in their homes by paying only 25% of the original monthly payment. This is not only true for personal loans. Banks do the same for developer loans as they are under immense pressure from the guaranteed delivery policy. Banks now not only look at project profits and location, but also scrutinize the company's financial situation as a whole. Loan disbursement is linked to the progress of the project, and the bank sends employees and even drones for on-site work supervision to prevent developers from committing fraud. Banks also take the initiative to help developers find financing to ensure that the project does not fall through and that buyers do not fall behind in their mortgage payments. The underlying reason behind these moves is that the supply and demand relationship in the real estate market has fundamentally changed, and the mortgage market has changed dramatically as a result. Banks can no longer make money easily, but need to be careful in all aspects of their operations and strive to maintain stability.